This market sell-off has the potential to get a lot worse, really ugly, really fast, and catch a lot of people off guard if it does. If you are 55, 60, 65 years old and you have an all equity portfolio, you may be up against the real litmus test for your risk tolerance. In recent years, I have met scores of people who are in that age bracket who are all stocks or all stock market exposure. Not prudent if you're entering retirement or getting close to it, but many people are going that route. And I think the reason is that it's been so long since we've had a recession, a real one. 2008, right? It's been a long time that many people have forgotten what it's like to enter a real bear market. So I'm going to show you some signs that I see out there that are very concerning to me. No one can predict the future with 100% accuracy, but there's a lot of reason to be concerned right now. And the sell-off that you're seeing today, it can intensify. It can get so much worse. And if we do enter a recession, you may not see a recovery for technology stocks like the Magnificent Seven, which I think are in a bubble. You may not see a recovery for many years, as long as a decade or longer. And I think that that's what many people are just not preparing themselves for. This is not business as usual. What's on the horizon is going to be a change that many people are not prepared for. We are seeing a significant divergence between growth stocks and value stocks year-to-date 2025. As the Magnificent Seven and technology trade implodes, value stocks, the purple line, become more attractive. Year-to-date, as of March the 7th, the Russell 1000 value total return is up 2.5%. The Russell 1000 growth total return is minus 5.5%. With the selling action today, March the 10th, the divergence is now much greater. This is concerning because of what happened the last time that technology stocks fell apart. Let's take a look. The last time we saw a technology bubble implode was the year 2000. On this chart, we're comparing the same two indices, the Russell 1000 value total return versus the Russell 1000 growth total return for the year 2000. And you can see that in the last quarter of the year, these two indices exhibited a wide divergence. The growth index, aka technology stocks, Magnificent Seven today, fell apart. The value stock index trended up. Huge divergence here. Value stocks finished the year positive 7%. Growth stocks finished the year minus 22%. Things can get a lot worse from here for the Magnificent Seven stocks. If you had $100,000 in these two indices back in the year 2000, look where you were at over a decade later. If you were in growth stocks, over a decade later, you only had $76,000. 10 plus years is a long time to lose money on a total return basis. If you were in value stocks, on the other hand, you were almost 40% ahead over 10 years later. Where do you want to be in the future? If we are at the turning point for the business cycle and technology stocks are going to continue to come under pressure, which they probably will, you really want to think about how your portfolio is allocated. The yield curve recently reinverted. Yield curve inversion has preceded every recession for over 6 decades. Recessions are the gray bands on this chart. Inversion happens when the area of this chart is below zero, like it was in the year 2000, right before the 2001 market meltdown for technology stocks. Here we see inversion happening before the 2008 recession and before the 1991 recession and all the other recessions. Now, I know some people are saying, well, we've been inverted for a couple years and there is no boogeyman. The recession's not here. But take a look at what happened before the Nifty 50 bubble burst right here circa 1970. We were inverted for several years on and off, and then boom, it was lights out, and very painful at that. So I wouldn't rule out a leading indicator like yield curve inversion because it's probably still valid. Unemployment, which is a lagging indicator, appears to have bottomed and is now moving up. It's at 4.1%. When you look at the long-term unemployment graph, you can see that unemployment rarely stays in one place for any length of time. It's always going down or going up, trending down, never static. If we have turned a corner with unemployment, by the time it really moves up, we'll already be in recession. You can see that in past recessions, unemployment just spikes. It massively jumps up. And when that happens, you're already in recession. So here we have a lagging indicator moving higher, and we have a leading indicator, the inverted yield curve, both telling us that a recession may be very close. There have been 14 bear markets in the last century with an average loss of 38% and an average duration of 18 months. Most of these bear markets were associated with a recession. If we have a recession in the near term, I think it is likely that we will have at least the average loss and probably more due to the bubble in AI and the Magnificent Seven stocks. When those stocks melt down, it's probably going to result in greater losses. We've been in a bull market for 17 years. Eventually, the business cycle is going to turn, or at a minimum, market leadership is going to change. I wish I could predict exactly when the business cycle is going to turn. I've been concerned about it for over a year. It looks like we're getting close to the business cycle changing. The White House is working on policy initiatives that I think are going to be productive, but it's going to take a few years. And we may have a period of pain before we see the real positive effect of what the White House is working on. In the near term, it's likely that we're going to see unemployment go up. We may have a recession, and nobody knows how deep the recession will be if we have one. What I think you can be confident in is if we do have a recession, the AI bubble and the Magnificent Seven stocks are probably going to come down in a big way. There are a lot of people making YouTube videos talking about buying the dip. But what if this isn't a dip? What if this is the start of a new trend for growth stocks, and that trend ends up being down like it was 25 years ago? Eventually that's going to happen. I made a video on an all equity stock portfolio in retirement. Some young professors produced a so-called research paper on having an all equity portfolio, and many people made YouTube videos suggesting what a great idea it is. It's not a good idea for most people. I think if you're in the very small percentage of people who can tolerate that kind of volatility, good for you. It is great for you. If your time horizon is a perpetuity, you will make a lot more money. But I think for most people, as I said earlier, the litmus test is here now. If this market continues to trend lower, how are you going to react to seeing your life savings get cut in half? If you're 55, 60, 65 years old, can you tolerate seeing half your money taken off the table or more? It could get worse. We just don't know. It's a whole lot different losing money at age 60 than it is at age 40 or 42. If you're 60 years old today, you were in your early 40s at the time of the last recession. So watching your retirement nest egg come down precipitously right before retirement is going to feel a whole lot different than when you were in your early 40s losing money in the last recession. This time, it's going to be a lot different. So it makes the case for having an asset allocation that you feel confident in. Having an asset allocation that is aligned with your retirement planning and your risk tolerance. My experience in recent years has been that there are many people who are out over their ski tips. They are taking far more risk than they realize. And when these chickens come home to roost, they're going to get a rude awakening, unfortunately. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.